Well, let's turn the spotlight on the IT sector. That was the one that was buzzing yesterday in 2024. In fact, the IT index has outperformed the Nifty. Jeffrey says that the recent move may lead to price-to-earnings re-rating. To help us out with a quick analysis, we're joined by Sandip Agarwal, fund manager at Sowilo Investment Managers. Hi, Sandip. Good morning. Thanks a lot for joining in. What's your take? The Indian IT space has outperformed the Nifty. We're trading at valuations in excess of what is the norm, in comparison to the 5-year average, and also at a premium in comparison to what Accenture is trading at. Your view on the sector from here on, and what's the top pick?
So, hi, good morning, and thanks for having me in the show. So, Nigel, we have discussed this many times in the past, and I will reiterate that, this is a sector where large caps generally should see a revenue growth of 8-9% because industry grows at 3-4%, outsourcing grows at 6-7%, and we gain some market share every year because of benefits of scale, availability of manpower, and all that. So our large cap grow at 8-9% on average, and because of some improvement on the margins, the EPS growths are generally 11-12%, also partially aided by buyback of shares, which reduces the share count. Now, this is the actual mean average which the sector does because it is a matured sector. But when 1 or 2 years you don't see any growth coming in, or the growth is below this mean, then it all gets bundled up and shows up in the third year or second year, and the stock performance are little outsized. So I would say that this sector should be seen as a pure long-term investment sector where you should expect on an average, if you are putting your money for 5 years, 10 years, you should expect 12-13% on the large names, and the mid-size good quality names you should see 15-16%, and the small ideas, if they work out, you can see 20% CAGR on the performance. So that is the way this sector should be seen. So in Jan and Feb, there was extreme pessimism at that time. Also, our view was that, given the data of how attrition has come down sharply, the margin should surprise. And I'm telling you today also on the call, this quarter, you will see bumper margins by all the players. And every analyst will run to, upgrade the numbers, and the stocks will also move up. And then revenue growth will come after that. And once revenue growth starts coming in, you will again see attrition picking up and slowly margin is tapering up. But we have another 2 quarters where this stock should do well. That is what my sense is.
And your preference would be between the large, the mid and the small cap companies? What would it be? Because the growth is going to be better in the small cap names on a lower base. But, if you're allocating, say, $100, how would you split it up?
So, we run a PMS, so it is very hard to call out the names of the stocks. But let me put it this way, that within the large cap, the stocks which are trading at a much reasonable valuation and where there is turnaround stories likes of HCLTech and Tech, they will still continue to surprise from here, in my view. Similarly, in the good quality mid-cap names, if you leave aside the R&D names, ER&D names, because in ER&D, I still believe there is a small blip which can happen because of availability of manpower. It is still challenging in that area. Then you can get good opportunity to buy some of the names. But otherwise, the mid-cap IT services names are really overpriced in my view. Better to look at some of the names in the small space where the stocks have not moved up, and they also, the margins are at bottom. So, likes of FirstSource, likes of Gensar, likes of Buildersoft, these on some of the names like Onward and Axis Gates. These are the names where, there is a lot of scope for improvement of margin and growth momentum. So I would generally prefer a ER&D small cap or mid cap play where, there is some correction, or if they are little reasonable, because see, ER&D any which ways for next decade will outperform IT services by at least 2x. So best to play ER&D at reasonable valuation. That is what I believe. And in the large cap, you play the names which are reasonably priced. So you have a play in large cap and you have a play in small cap. Mid cap, I think, is an overcrowded space now.
Okay, so ER&D, that's the place to be in. Got it. Just to go back to the earlier points on the morning, to go back to the earlier point when you said that if you're looking at a long-term exposure, then expect, I think you said 12 to 15% kind of return. And that's on a stock level basis, right? That's the overall return to expect steady state long-term from IT in your portfolio. That's the point you made, right?
Yes, absolutely. So what I'm trying to say is that, this industry is 8% revenue growth and 12% earnings growth. So you can expect 15-16% kind of stock return for the large names on a stable basis. So if it has not come for 2 years, in the third year, it will come 30-40%. It has always been like that. If you see last 10 years, it has been like that only.
No, absolutely. So now the question is, what's the kind of multiple that you're willing to pay for that? It's not bad, right? Steady state. if you're saying the Nifty earnings compounding and overall compounding is supposed to be between 12 and 15%, and long-term IT will give you the same with reasonable margin of safety, cash, etc., etc. So maybe it's not that bad. But the question is, how much are you willing to pay for it? So multiples right now versus the peak, what's the further expansion that you think will still be digested by the market?
So I think 2 to 2.2 times PEG ratio is what anyone should assign. So I think for the large names, anywhere between 22 to 30 times is a reasonable multiple, because as you rightly said, there is a lot of cash balance stability and all that thing. And also remember one thing, that last 1.5 year, NASDAQ has finally made a new high now. And, most of the companies have done phenomenally well, and now the numbers will start tapering off. So the follow-on will be on Indian IT. We have not yet got the benefit of the growth which the ultimate market has seen. So always we see an impact with lag effects. So we will have honestly 3-4 very good quarters in that sense. So 2 quarters superb revenue growth and margins, and then followed by 2 more quarters of good revenue growth but mellowed down margins. So I think we have to yet get benefit of, and it always happens like that, we get benefit for next 3-4 quarters after this Apple and Google and everyone does well. So we have next 4 quarters which are good in my view.
Next 4 quarters could be good. Okay, we'll have a longer conversation later. I mean, your point was 30 times earnings, price to earnings is perhaps what would be fair, which is exactly where these stocks are. I mean, the sector as a whole, Nifty IT at 30 times. So let's see if there can be any further expansion. Thank you very much. Little short conversation today because we are running into market opening, but really appreciate your views.